Welcome, everybody, to another glorious episode of Cash Flow Positive. The big, beautiful bill passed. And some people are screaming and kicking and crying and saying it's the end of the world, and other people are really happy about it. So the real question is, how does it impact you? And especially as a short-term real estate investor, you might think you know all the answers, but let's confirm that by bringing in one of the best CPAs and tax strategists, I personally know, Ryan Bakke, who's going to come on here and tell us and break down almost everything in that bill that impacts you and why that's important. But more importantly, if it does impact you, the action and the steps you need to take to find a cash flowing property before the end of the year. So without further ado, Ryan, welcome to the show. Tell us more about yourself.
My name is Ryan Bakke. I have an accounting and finance degree. I'm also a real estate investor. I originally started investing in long-term rentals. I read all the books about the Bigger Pockets, the Brandon Turner, all the blue books about if you buy, get a $300 cash flow per door and 100 doors later, you're financially free. And I bought my first couple of properties and I'm like, man, this is going to take a long time. And then I actually just got back from a trip to the Smoky Mountains back at late 2020. And I'm like, these people made $400, $500 a night for my family to come and stay there. I might want to try this Airbnb thing. And so the property that I had that I was renting out for $11.50 a month to a long-term rental, I decided to get the tenant out and start short-term renting it. And the first month I made $3,000 in gross revenue. And that was a clear path forward to me to achieve financial freedom as opposed to buying 100 doors. So I went down the short-term rental route, and me having a CPA background, I started studying the tax code, and I realized middle 2020 of the advantages that short-term rental investors have that other real estate investors don't get. Most people who work a W-2 or own a business, if they buy long-term rentals or multifamily, they're not able to write off the tax losses against their income like short-term rental investors are. We've been doing it ever since. So the last 4 years, I've been a subject matter expert on Airbnbs, short-term rental investing, and tax strategy.
All right. Yes. And I've personally used his tax strategy, his program, Tax Strategy 365. And so, yes, they know what they're talking about there. So, all right, Ryan. First off, are you still running that the laundromat? Are you still doing that?
I still own it. Yes, I do.
How's it doing?
The laundromat business is interesting. That was
nuts, right?
It's quarters, mostly quarters.
Mostly quarters, yes. Did you ever put in the slot machine?
No.
Okay.
No, it goes against my moral compass. And I lose a lot of money for it. And over the years, my laundromat has been kind of declining, but because I don't want to put the slot machine in. I actually had somebody give me an offer for it recently, and I should sell it, but I just know the guy's going to take it and put it in slot machines, and it's going to be all these laundromats in this area. They're casinos disguised as laundromats. I swear. You go in there and there's four slot machines in a laundromat. I'm not kidding. I don't know if the gas stations by you are the same way, but you get off the highway and you go into one of these huge gas stations nowadays, 8 to 12 slot machines in the gas station, and most of the time they're filled. Go there on Friday after 5, all the slot machines are filled. It's crazy. It's stealing money from people.
Are there any tax savings for businesses that do slot machines?
Well, that is one part of the tax code, is that the slot machines are going to be fully written off in the first year, regardless of if you pay cash for it or you take out a loan for the slot machine. Typical slot machine, the good ones nowadays are going to run you 12 to 15 grand per. But I think the average slot machine probably makes their money back within 2 years.
Gotcha.
Not to mention the tax benefits, because you could find, you could put 30% down on a slot machine, which is $3,000, you're going to save more than $3,000 if you write it off for tax purposes.
That's a really good point. So what you're saying is we need to put a bunch of slot machines in our Airbnbs.
I don't, maybe,
Can you imagine?
maybe the ones in Hot Springs.
Yeah, there you go. The one in Hot Springs. Yeah, I should call up John Hodge and be like, John, I know the best amenity, the highest ROI are slot machines.
Or maybe like Panama City
Airbnb.
Beach.
What's that?
Maybe like Panama City Beach, where there's a lot of retirees and stuff. You know, like they want to gamble.
There you go.
We should tell John to
Airbnb like themed casino. Oh, actually, I wonder. I don't know. I wouldn't do it, but I don't gamble. But it'd be interesting. Take the poker table to the next level. Anyway, okay, we're going to talk about the big, beautiful bill. Was that the final name of it, or didn't they change the name or something? Oh, it's still Big Beautiful Bill. Okay, all right. So it's been signed. It's law. There's been some big things. Obviously, we're going to talk about bonus depreciation for a hot minute, but there's some other things too that have passed in it. But let's start with bonus depreciation, because that has been a hot topic and a reason why most of the people listening to this are investing in short-term rentals, and maybe what got them involved in it, besides they want to rent out random houses to random people, were the tax savings. So first off, what is bonus depreciation?
Yeah, when you buy a rental property, there's an intrinsic amount of tax savings that are in every single property that you buy. And that obviously depends on the purchase price and the location that we've talked about before. But the investor that's never heard of bonus depreciation, and they're just taking their tax return to H&R Block or somewhere down the street for an accountant that doesn't know what bonus depreciation is, they're getting those tax savings over 39 years. So easy math, if you bought a $400,000 building, you're getting $10,000, 400,000 divided by 40. You're getting $10,000 of depreciation every year that you can use to offset your tax liabilities. So if I'm in a 30% tax bracket, every year of owning the property, I'm going to save $3,000 in taxes. And it's a lot. What bonus depreciation is, it's kind of like those commercials, if you've ever seen them, where it's like, it's my money and I need it now. Or in Chicago, we have all these. It's J.G. Wentworth, 877.
Of course, J.G. Wentworth. They have a really good social media presence. Like I see them like on, like commenting on people's stuff, where they're like, oh, that sounds like the J.G. Wentworth commercial. And they'll comment back and they'll be like, almost, but thanks for giving us a shout out. Just funny things like that.
But the bonus depreciation allows you to get 25 to 30% of your total tax benefits on a property in the year that you buy it, right? And you're going to get the other 70% over 39 years. But now that you've saved, so on that same property, instead of saving $3,000 in taxes the first year, you're going to save $25,000 to $30,000 in taxes in the first year. And that's pretty powerful. I mean, think about a $400,000 house. Like if you did a 10% down loan, not that we would recommend it all the time because of interest rates, but you're getting 75% of your down payment essentially recouped through tax savings in the first year. So that's why it's extremely powerful, especially for people who are high W-2 earners, to leverage bonus depreciation when they buy properties, because it's going to allow them to recoup the cost of their investment a lot faster.
Okay. So two things with that. You get the $40,000 to $50,000 in tax savings. How does that impact people who are who make a lot of money, or high W-2 income earners, like you say? Why is that impactful for them? Obviously, you're saving $40,000, $50,000, but like, how does it work mechanically? Yeah,
the higher your income, the more advantageous it is going to be for you. So we normally, if you're in a low tax bracket for whatever reason, like either you're just like doctors who are just coming out of residency and they're just starting off their careers and they haven't made a lot of money yet, you don't want to take bonus depreciation when you're in a super low tax bracket, unless you can couple it with some other strategies. But the idea is okay, you're going to save that 40 or 50 grand and you're going to go reinvest it and not spend it on like a Porsche or a vacation to Vegas or a casino in Hot Springs, but you're going to actually reinvest that money. And now those tax savings are going to compound on each other, right? And Rule 782 says, your money is going to double every 8 years. When you invest it properly, right? So that 50 grand that you save now turns into 100 grand in 8 years, or potentially even more if you're a smarter investor, and you can buy properties.
Okay. So here's an interesting question. If, let's say, you are a doctor that's just getting into residency, or you're not making that much money, you don't need to do a cost segregation or take advantage of bonus depreciation. Should you just wait to buy a short-term rental until you need to take advantage of bonus depreciation, or can you buy a property and then take advantage of this strategy down the road?
Yeah, I would always tell people you don't want to buy solely just for the tax savings and benefit. You should buy the property first because it cash flows. But that's one of the great things about the tax code and the way that it's written is you can go back and amend your tax returns if you should be taking bonus depreciation now. Like, let's say you went from making 80 grand a year to $300,000 a year, and you're like, I want to do bonus depreciation now, and I'm a higher tax bracket. You can do that if you have the right strategy and the right team in place, and that's what makes it pretty powerful. Because when you buy a property, and let's say you've had the property for 2, 3, maybe 4 years, but your income continues to go up, like we can take the depreciation in the year that serves you best, whichever year is going to save you the most amount of money in taxes.
Gotcha. Okay, so you can buy a property and just in the future do bonus depreciation. Okay, on it.
Yeah. Now there might be for those people that we just talked about, there might be scenarios in which they want to lower their income. I can think of a couple off the top of my hand, or like people who are on income-based repayment plans for their student loans. So the income-based repayment plan basically says, okay, your student loan's $300,000, $400,000 because you just spent the last 10 years learning to become a doctor. And if typically your student loan payment, by the way, is going to be about 1% of the total balance. So if you have 300 grand in student loans, like your payment's going to be minimum $3,000 a month for a long time, and you're not even really denting the actual principal. Now, these income-based forgiveness programs are like, hey, if you pay a certain percentage of your income for however many years, we'll forgive the loan. And those people are able to like artificially lower their income, which then would lower their monthly payment. So like I've seen people who should have had to pay, I'm not even kidding, like $4,500 a month. Like now, because they're able to lower their income, they only have to pay $1,100 a month or $800 a month. So that might be a scenario in which you would want to try to lower your income through bonus, so that way your income-based repayment is lower.
Okay. Give me a quick 1-minute breakdown of what exactly is a cost segregation study and how does somebody get one?
Yeah, so the cost segregation study, when you buy a property, that $400,000 property, you don't know exactly what everything in the property is worth when you buy the property. Like you're just buying the $400,000 property. That's what it says at the contract price. So you have to do a cost segregation study to actually identify what are all the materials inside of the property, the cabinets, the furniture, the millwork, the HVAC, because a lot of that stuff inside of the property doesn't have to be depreciated over 40 years. It can be written off in the first year. And the cost segregation study allows you to write off 25% of that $400,000 building in the first year. If you don't do the cost seg study, then you're not able to get that big write off in the first year.
Okay. All right. That's good to know. Okay. So, how in the big, beautiful bill, this was referenced in a way. So, what changes did we see because of the big, beautiful bill passing?
Yeah, before 4 days ago, the bonus depreciation was starting to sunset. So it was 100% all the way up into the end of 2022, and then it was 80 for 2023, and it was 60 for 2024, and then If you bought a property from January 1st through January 19th of this year, it's 40%. But the law now is pretty much extending bonus depreciation, actually making it permanent for properties that are placed in this, or properties that are under contract after January 19th and placed into service after January 19th. Those taxpayers are going to be able to get 100% bonus depreciation on their properties.
Okay. Give us a quick math example difference between the 40% and the 100%. Like how impactful?
Yeah, I just looked at one yesterday it was a single taxpayer making 250 grand a year, bought a $550,000 house. At 40%, they're saving $18,000, and at 100%, they're saving $40,000. So that person's pretty much getting 2 to 2.25x their total tax savings from it going from 40 to 100. So it's a huge deal, and it only increases the higher the property that you buy and the higher your taxable income is. Because single making 250, they're in a 35% bracket. They're not even in the highest tax bracket, actually. So it means more to people who buy bigger properties and also people who have higher income, which kind of goes hand in hand.
To be clear, the 40,000 is off of the 250, or how does that kind of break? Like when you say the tax savings is 40,000?
Yeah, the first thing you have to calculate is what is the estimated depreciation from the property, which is going to depend on purchase price, building the land allocation that we talk about a lot, right? So you have to figure out what's that depreciation number. That's not going to change based on your income. Whether you make 50 grand or 500 grand, that depreciation number is not going to change. When you have the depreciation number, what is going to change is how much is actually going to save you, because that will be based on what your tax bracket is. So if I have $100,000 in depreciation and I'm in a 32% bracket, that saves me 32 grand a year and 32 grand on taxes. If I'm only in a 12% tax bracket, that's only going to save me $12,000. So a huge difference based on what tax bracket you're in. And we've saved people 5 figures or more just by telling them exactly when to take the benefit. Like, hey, you should do it this year instead of this year because you made more money this year instead of last year, or whatever. Like maybe you made more money before, but now your business isn't doing as well. Like you should take it in the year that you have the highest income.
Okay. All right. So with the bill passing now, why I gotta ask this question: why would Donald Trump or the Republicans? We're not getting political here, but just why would they care about bonus depreciation for short-term rentals? Like, why is this in the
bill? I'm not sure if they specifically carved out short-term rentals necessarily instead of real estate as a broader picture, but you have to remember, like, who actually writes the tax code? It's Congress. So, and people in Congress, they're normally business owners, people of power and status before they even get into Congress. And so either they or their constituents, the people that they're voting for, like the residents of their state, are also going to be business owners, real estate investors, stock investors. And so when they write the tax code, they have the investor in mind. And that's why they write those laws a certain way. So I think what they've noticed is that over the last 2-3 years with inflation and rising costs, and now there's looming, tariffs all over the place, people are scared to invest money into the economy, especially with where interest rates are at, right? So people have been hoarding on the cash and just leaving it in a bank account. And so in order to incentivize people to actually spend money and invest in the economy, they want to write the tax laws to incentivize that behavior. Because, think about all the people that get paid when you buy a short-term rental property. So you might have a deal where it's like, okay, it cash flows, but it's not the sweetest thing. It's not a 2020 or 2021 deal, Smoky Mountain cabin in the 2019 or 2020. Like, it barely cuts mustard. But when you look at bonus depreciation and then post bonus depreciation, like going from $18K in tax savings to $40,000 in tax savings, that's going to shift people's behavior. So all the people that get paid when you buy a property, right? You have realtors are getting paid, title companies getting paid, cleaners, handyman, contractors, accountants, lawyers, Kenny. All these people are getting paid when you buy a property, and so the government wants to incentivize that behavior because it grows the economy. Not to reference the former president, but it grows the economy. And then think about your guests or your tenants that are going to stay at the property. Also, it gives. Had you have not have bought that property, there would be nowhere for them to stay and come and travel, right? And so I think about all that and how they pretty much write tax policy to influence economic behavior, influence people's decisions to either invest in certain things or not invest in certain things. That's why there's call outs for people who are in the gambling industry. They want to disincentivize people from gambling their money away, so they limit the amount of deductions that you get for gambling. Right?
There goes the slot machines.
Actually the proposed rule is pretty crazy. You have to report all your income gambling wise, but you don't get to deduct all your losses. So, let's say you made $1 million at a casino, but you also had $1 million in losses. You, my friend, have $100,000 income because you're only able to claim up to 90% of your losses. So that's their way of like disincentivizing that behavior, is to limit the amount of deductions that those people get. And gambling is not just the only industry. Like the cannabis industry, cigarettes, all those types of behaviors. Like the tax code is like disincentivize that activity a lot.
That's interesting. Okay, so the question that you had a good webinar workshop yesterday, and you got a lot of questions. But the question I kept seeing kind of in around this topic of with short-term rentals and the bonus depreciation. What if you have a long-term rental or a midterm rental? I mean, those are technically two separate things. Can they both take advantage of bonus depreciation?
Any type of real estate property can take advantage of bonus depreciation. So whether you have a LTR, STR, midterm rental, glamping, it doesn't matter what you do. You can still do bonus depreciation. The biggest question is, well, can you actually deduct it against your income? Right? That's the biggest question. So somebody who works a W-2 that has a couple long-term rentals, because they're not a real estate professional, they're not going to likely be able to use that to offset their income. Now, if they have a ton of rental properties, like if they already have 5 or 6 cash flowing properties and then they go and buy another property, well, great, because then you're going to be able to offset the properties that have income with the new property that you bought. So you have to ask yourself, like, do I actually qualify to take the loss against my income? Because that's going to be what makes you pull the trigger on doing the bonus depreciation or not. Gotcha.
So you can do it with any type of real estate, but it just does it impact your income? So it's really good. That's really good. Okay, cool. So bonus depreciation is back. How long is it back for?
Permanent.
That's awesome.
Permanent until the new administration cuts it out again.
So
okay. Yeah, we'll see. So it's permanent for now.
What's up with this date of 2029 I keep seeing floating around?
It was originally written, it was extended to 2029. That was in one of the earlier stages of the bill. And then the bill that was signed into law by the president doesn't have an expiration date on.
Nice. Somebody came in with a nice eraser and was like, "What?"
Yeah. He's like, "Oh, sorry."
Yeah. And everyone's like, whatever. We didn't see that. So, that's great.
That's one thing about tax code that's so interesting is, we're making a lot of decisions now based on the facts and circumstances and the laws that are at play, but those could potentially change. One of the things that always is on the chopping block, when a new administration gets in is like the 1031 exchange, right? That's always one of the controversial topics of are they going to remove it, right? Because if they did, there's certain things where it's like you can plan for it today, but we don't know what the law is going to be 5-10 years from now.
Right. If that got chopped, would it get chopped immediate or would they sunset it?
That's a great question. If there's a couple of things. If they got rid of the 1031 exchange, then I definitely see the real estate market like taking a hit because people are going to be less likely to want to reinvest in other properties. Because there's some people that when they sell a property, the only reason they do a 1031, obviously, or like buy another property is so they could save money on taxes. So they don't have to give that money to the government. There was also some talks about eliminating income tax late last year. And I was like, that will never happen. And because of what it would do to the economy, like think about 401ks and IRAs. Like the stock market, if they eliminate income tax, the stock market would take a 50% hit overnight because those are tax deferred accounts. And so if those are tax deferred accounts for a reason because people have to wait until they're 59 and a half to touch that money. But if they're able to just cash out tax free, the stock market would take a 50% hit overnight. Same thing with real estate. There's people that will be 1031ing properties until the day that they die so they don't have to pay taxes. And if they eliminate income tax, like the real estate market would also take a hit. Charities would also be dead too. I know people have a kindness out of their own heart, but a lot of like charitable organizations wouldn't exist if there wasn't a tax deduction for it.
Yeah, that's interesting. Speaking of that, what did the bill include anything about charitable contributions?
So starting in 2026, there's going to be anybody can take up to a $2,000 deduction for charitable contributions. See, in the past, up until 2026, you have to itemize your deductions, which pretty much means you need to have a lot of personal deductions like property taxes, mortgage interest, gifts to charity. And so a lot of people weren't able to itemize and write off charitable contributions. But starting in 2026, people are going to be able to write off up to $2,000 off the top for any charitable contributions if they're married.
Gotcha. Is there any like level beyond that where it becomes more beneficial?
That's going to depend. So you can deduct as much as you want if you qualify for it. Now, how much you're going to want to deduct or how much you're going to want to donate probably depends on your tax bracket. So somebody in a 12% tax bracket is not chomping at the bit to give money to charity because they're only going to save 12%. Somebody in a 37% federal bracket and a 13% state rate where they're paying 50% on their income, like they're going to be more likely to want to donate to charity so that they can get a 50% reduction in taxes paid.
Mm-hmm. Okay. Cool. Let's talk about the SALT changes. What is that? What is SALT?
It's so hard to explain, but the SALT cap has been argued and battled over the last 8 years. So starting in 2017, they capped the amount of deductions that you get for state and local taxes. So your state income taxes, which are the income taxes that you pay to your state, and your primary real estate taxes, that has been capped at $10,000 from 2017 to 2020, the beginning of 2025. So I live in Illinois, okay? I pay $12,000 in my primary taxes on my personal residence, and I'm not going to say the exact amount of state income taxes that I pay, but I'll say it's over $20,000. Okay. So I pay $20,000 in state income tax and I pay $12,000 in primary tax. Under the old law, I'm only able to deduct 10,000 of that 32,000, right? Because it's capped at 10K. So all these people that are in high income tax states, high property tax states, California, New York, Jersey, Philly, Minnesota, like they're only able to deduct $10,000, right? Somebody making, not that it's, woo them, but like somebody making 800 grand in California that gives $100,000 to California and has a $15,000 property tax bill on top of that, they're only able to deduct $10,000 of that. It's crazy. But now starting in 2025, you're able to deduct up to $40,000 of your state and local taxes if you're under a certain income limit. So it's going to benefit us that I got a rainstorm coming in real quick. It's going to benefit those who are in, your Illinois, your New Yorks, your Californias, because now we can deduct 40,000 of that as opposed to only 10,000 before.
Is that only for primary residences though?
Well, remember, it's state income taxes. So if you're in a state that has income tax, you're paying state income taxes, right? So it applies to all those states. It's state income taxes and it's your primary real estate taxes, right? So you could get up to $40,000 of a federal deduction for those taxes that you pay, income taxes and real estate property taxes.
Gotcha. But that wouldn't apply for like short-term rentals, like property taxes you pay on short-term rentals.
Yeah, if you own a rental, the taxes that you pay, the interest that you pay is always fully deductible if you're running a business out of your rental property. It's your personal primary home that you're not always able to deduct taxes and interest and things like that.
Gotcha. Okay. No, that's really good. All right. No, that was pretty clear. So
yeah, so it's huge because the $40,000 lift applies to married couples who make less than 500 grand a year, AGI, adjusted gross income. Okay, and so why that's important is because hey, if you're married and your gross income is below 500K, you get your $40,000 of deductions. You're good to go. If you now it's at 500K to 600K, it starts phasing out. So if you make over 600 grand, then you don't get the additional 30,000. You're still stuck back at the 10,000, right? So if I accidentally have an income event, like if I get a 1099 at the end of the year, or if I sell a property and I juice my taxable income, I could theoretically like not get $30,000 worth of deductions, and it's going to cost me more in taxes, right? So if I make 500K, so think about this: if I make 500K or below, I get my full 40K of deductions. If I make over 600,000, I lose that additional 30,000 of deductions. So by increasing my taxable income by $100,000, I actually increase my taxable income by $130,000 because I lose that $30,000 deduction. Okay. So it's like a double whammy. Like I increase my income above that threshold, which is taxable, and I also lose that deduction. So that's why if anybody's listening to this, if your married joint income is 500K and you're always in that kind of like 5 to 600K range, this is super important because it's effective this year, retro to January 1st. And that's why like planning for this could be impactful, because not only can you save $30,000 or $40,000 when you buy a new short-term rental property, but that'll lower your AGI so that way you qualify to get that other $30,000 deduction, right? That you otherwise wouldn't have gotten if your income was 600K. And now you're saving the 40K on your short-term rental plus the additional $10,500 in your state and local tax deduction.
That makes sense. Yeah, no, I think it's so important to sit down with a strategist who understands these changes, and also don't sit down with them in the year after your tax. You owe taxes, so don't be having a conversation with a strategist in 2026 about 2025 taxes. It's too late.
Yeah, it's way too late. See, at least like if you reach out to us in August, September, October, like there's still stuff that we can do before the end of the year. So we might sit down in September and project your income out, and it's like, hey, your income's going to be 580 grand projected. We have to get that down below 500, so you get that additional 30 grand in deduction. You're thinking about buying a short-term rental. Well, like we got to get that thing live and going this year, so that way you can lower your tax bracket below 500K, not only save money on the short-term rental through cost segregation, but then also qualify for the additional $30,000 deduction.
That makes sense. Yeah, I mean, and I think time is of the essence. I know that's what I talked about in the episode before this, but it's really, for those of you looking to make moves this year and save on taxes, like you got to start now. The further along we get, you procrastinate, the harder it's going to be to find something that, like you said, Ryan, you don't want to let the tax tail wag the dog. So finding something that cash flows, So finding myself having more and more of those conversations. I'm like, it's that time of year again.
But we've been telling people all this year that they should start buying now.
Oh yeah,
like
of course.
we've been preaching that for a while, because like it was probably one of the best buyers markets that we've ever seen in the last couple of years. Earlier this year, you were able to put in offers under asking price. There wasn't many competing offers. You were able to get in all your contingencies. And now with bonus depreciation coming back, buyers that were on the sidelines are now going to enter the market. And when more people enter the market and are interested, that's where you're going to see prices rise. You're going to see more offers in each property. It's going to be the good conventional offers that went out, the offers that don't have as many contingencies. And so the longer you wait, the more you're going to pay, and the less contingencies you're going to be able to put in your deal the longer that you wait.
Yep. No, I love it. It's don't wait is essentially the synopsis here, because a lot of other people are going to wait or find out about this as we're talking about it, and then they're going to want to take action. It's just a snowball effect. So, okay, cool, Ryan. So what else? So I mean, obviously there's some other changes. There's the Trump accounts and some other like minor things, but any other like implications or impacts from this bill passing that would impact short-term rental hosts for the better or worse?
I would say one of the items that indirectly affects short-term rental investors is the no tax on tips and the no tax on overtime. Okay. Now you might be listening saying, well, like I don't get tips and I don't make as much overtime, so how does that impact me? It doesn't impact you directly. It impacts you indirectly, because think about the people that are staying at our properties, right? Like the lake house that I have that I rent out for $180, $200 a night when I first started. Who's renting that property? It's a blue collar guy that's making 85 grand a year. It's the two income household that's making 100, 120 grand a year that are likely to be making tips and overtime. And if they believe that they have more disposable income now, that they don't have to pay taxes on up to 25,000 of those tips and those wages, they're going to be more likely to stay and come visit our properties. I think that's my personal belief, but it makes sense that if they believe that they have more disposable income, they're going to be more likely to travel and come visit and stay at our properties and spend money on our slot machines, maybe.
I've already got it's Prime Day. I've got a couple orders in right now. I'm just kidding. I don't know if Amazon sells slot machines.
Let's see what else I had in there. I think 179 deduction is very important for people to understand, especially after they've already owned the property and they're putting in pools, hot tubs, lazy rivers, like gardens, because they're able to write off the cost of that 100% when they put it in the service, rather than having to deduct it over time. So that's another thing too, like heavy machinery, cars, trucks, all that the prices of those things are going to go through the roof now that 179 deduction's back and it's expanded. Actually, each individual taxpayer, whether it was like a individual or a corporation, was only allowed to do $1 million of 179 deduction per year. Now it's $2.5 million. So these corporations are going to be more likely, like trucking, limousine, those types of things. Like they're going to be more likely to spend money on those types of items, because they're going to be able to deduct up to $2.5 million per year, as opposed to only $1 million a year.
Right. That makes a lot of sense. So that's really interesting. So it sounds like the bill that was passed, it's now law, was really geared on kind of, I wouldn't say jump starting because the economy is still going, but really like giving it a shock or an injection of incentivizing people to spend money.
I would say it's kind of like when you go to a water park and you're loaded, you got your tube and you're getting up on top of the slide, and the guy like jumps up and gives you the kick or the push off. Like that's essentially what it is. It's like there's a lot of people that we come across. They've been on the sidelines just waiting to redeploy capital and invest, and these laws are giving them an added incentive to want to pull the trigger.
Right. And I think too, with interest rates really being stagnant for the last 2 years for the most part, when I say stagnant, plus or minus a point, like it's really not, it hasn't gone below 6%, and it really, for the types of loans that we do, and it hasn't really gone above 8%. It's been in the sevens, mid sevens, down to like 6.5 usually. So like it's really just been stagnant, and so I think a lot of people, especially in the real estate world, there are a lot of people who are on the sidelines like waiting for prices to go down or interest rates to drop down, and there hasn't been a lot of like change, and so they just sit and wait. And I think this is going to jump, like you said, jumpstart or kickstart people into taking some sort of action, like give them that little like, okay, let's go now. A lot of people get nervous over uncertainty, even in our space. Like when the tariffs were announced, oh man, we had like 5 or 6 clients like, I'm going to put buying on hold right now because like we don't know what's going to happen. That's fair. Like, sure, we don't know what's going to happen, but now you just had a huge buyer pool leave the market because of uncertainty. And that was actually a really good time to start buying and negotiating in deals because there's uncertainty. It's kind of like this like catch 22. So now I think that's going to go away, and we're going to see some bidding wars this winter season as people are getting desperate to buy for the tax savings. So anyway, cool.
And it may not pick up right away. Especially like there's a lot of markets where right now is their peak season. So it's summertime. Like you'd be dumb to sell your property right now if you're peak season making your highest ADR right now.
Yeah, no, not in July. Yeah, July or August, September. That's the magic.
September, October, when those bookings, when the houses aren't as occupied, like there's going to be sellers that are going to want to list their property because now they know that there's more eligible buyers, and it's sort of similar to interest rate effect on prices and demand. So every 1% that the interest rate goes down, another 5 million people can afford to buy a home, is the mathematical across the country type of economics. Now, I don't think that because bonus depreciation here, another 5 million people are going to go buy a short-term rental, but it's going to have some effect on prices and demand, directly, because now that deal that barely penciled out that you're just like, it'll work, but I don't really want to put a lot of time and effort to only make this much money. Now that they have the bonus depreciation and there's like a little bit of economic certainty back, like people are going to be more likely to pull the trigger on that.
Yep. I love that. So be smart about it, though. Definitely be smart about it. I had an interesting conversation with the gentleman today who was like, I want to buy in this beach market, and I'm going to use property management. I don't care if it breaks even. And I was like, man, you're going to be lucky if it breaks even. And he's like, well, I just need the tax savings. And I was like, are you cool paying like, $3,000, $4,000, $5,000 a month, depending on what you buy it for, out of your own pocket, and having, wear and tear and all these other things on this property? And if you get to go see it once a year. And he's like, well, when you put it that way. And I was like, yeah, don't buy just for the tax savings. So
yeah, because even if you, in that example, like even if you saved 6 figures in taxes, you're losing $3,000 a month. You're like, you would have netted even within 3 years on what you saved, and now it's like, well, shit. Now I'm just losing $3,000 a month. Like, there's no effect of that. But we have some clients that live in they're high income, they're doctors or tech investor, tech people, where like they don't mind losing $25,000 a year on a property because they know it's appreciating 80 or $100,000 a year. That's fine if that's your strategy. But for those people that don't make us that much money and are really trying to get out of their W-2 job and work less, like you have to be investing purely for cash flow, number one, and the tax benefits and the appreciation come second and third.
Mm-hmm. I love it. Yeah, it's funny. I get that too with people. You say appreciation. A lot of people always like when I'm talking, they're like, "Well, I want a property to appreciate." I'm like, do you want to property to not appreciate? Like, who wants a property to not appreciate? Like, yeah, I get that. But anyway, they act like it's like a predictable metric. So, cool, Ryan. Well, as we're kind of wrapping up here, how do people get in touch? Obviously, you guys do. You have CPA services. You have a lot of services, but and strategy. More importantly, strategy. How do people get in contact with you guys if they're interested in your services?
Yeah, all social media platforms, just at Ryan Bakke CPA. I have a podcast too, just the Ryan Bakke CPA Show. I have Facebook group, Tax Strategies for Real Estate Investors. And then if you want to check out our website, it's taxstrategy365.com.
Yep. So if you're not following Ryan on Instagram, go follow, or I assume you're on TikTok and all the other good stuff too. So go follow Ryan. But if you're interested in the services, go to taxstrategy365.com. If you're listening to this in a car, go watch this on YouTube, and you can see the link there on the YouTube channel at Cashflow Positive. Well, Ryan, thanks for joining us today. Thanks for breaking all this stuff down. I know people will find this incredibly useful and helpful as they're continuing their short-term rental journey, and hopefully they see the benefits of this bill passing.
Yeah, I'm excited.
All right. Well, thanks everybody for listening, and I'll see you on another episode of Cashflow Positive.